Hello, and welcome to another edition of MoneyWise. My name is Alan Sitkoff, and I'm a financial advisor with Smith Barney, a division of Citigroup Global Markets. For over 20 years, I've helped investors make better financial decisions, and that's the goal of today's segment as well. Today's program is called Building Your Financial Future with IRAs. Our goal is to discuss in detail some of the attributes of IRAs, an account that's formed the basis of retirement savings for many Americans. With me today is Roger Bush, also a Smith Barney financial advisor for over 11 years.
Hello, Alan. You know, today's program is full of important retirement information, so I'm happy to be here.
Roger, I'm also looking forward to exploring this topic. Let's take a short break, and then Roger will explain the fine points of building your financial future with IRAs.
Mom, shouldn't we pick a place to meet? If you're not home, should we go to the neighbors? Should I pick up Sophia at the babysitter's house?
There's no reason not to have a plan in case of a terrorist attack.
How do we keep in touch with each other if the phones don't work?
And some extremely good reasons why you should.
If we can't make it home, who will pick us up?
Talk to your family about what you would do in case of an emergency. For more information, go to www.ready.gov.
There's something you should know about me. I'm cold. I'm calculating. I get what I want. If you get in my way, I'll wreak havoc upon you. I can leave you weak, limp, twisted, confused. If you want to live to see tomorrow, you answer to me, and you answer quickly. I am a stroke.
Learn to recognize a stroke and act quickly. Time lost is brain lost.
AIDS has killed more children worldwide than there are in all the grade schools in New York, Chicago, Los Angeles, Washington, Atlanta, and Miami combined. The time to do something is now. AIDS has killed nearly 6 million children worldwide. That's more than every child in every preschool, grade school, and high school in New York, Chicago, Los Angeles, Washington, Atlanta, and Miami combined. The time to do something is now. The place is apathyisLethal.org.
Okay, here's a little pop quiz for you. Name any Oscar winner. Name one character from a Hollywood film. Easy, right? Oh, one more question. Name one character your kid learned about in English class.
Know what really matters. Know about your kid's school, and know about your kid. Find out 100 ways to know more, do more.
Welcome back to MoneyWise. At this time, Roger will take us through the traditional IRA information. Roger, it's in your hands.
Thank you, Alan. You know, IRAs are not just for retirement anymore. Whether your long-term financial goals are a comfortable retirement, perhaps first-time homeownership, or higher education for a family member, or even yourself, IRAs can really help. Today, I'll be concentrating on two such accounts, the traditional IRA and the Roth IRA. Both of these IRAs have different features and benefits, as well as restrictions on who can contribute. Since their creation in 1974, individual retirement accounts, also called IRAs, have formed the basis of retirement savings for many Americans. Anyone who is under the age of 70 and a half and has earned income, or is the spouse of someone who has earned income, can contribute to a traditional IRA. The maximum annual contribution to an IRA is $4,000 or 100% of earned income, whichever is less. Additionally, a catch-up contribution of $1,000 is available to individuals age 50 years or older. Contributions to traditional IRAs can be either deductible or non-deductible, depending on whether or not you're covered by a retirement plan at work. If you don't contribute to your company's 401k plan or any other type of defined contribution plan at work, you are always eligible to deduct an IRA contribution. The opposite would hold true if contributions were made into your defined contribution plan. In that instance, your adjusted gross income must be below a certain level. If you have a defined benefit plan at work, you are considered covered. So your income must be below a certain level to be eligible for a deduction. Although you may not be working, that doesn't mean you can't invest in an IRA, provided your spouse is working. Furthermore, you may even be able to benefit from favorable tax treatment within your personal IRA. However, there are several rules that apply to spouses and IRAs. A spouse, whether working or not, may contribute up to $4,000 annually to an IRA, plus the additional $1,000 catch-up contribution, provided they are age 50 years or older, and the couple's earned income is at least that much. The IRA is owned by the account holding spouse, no matter which spouse provided the funds for the contribution. The spouse who is not covered by a retirement plan at work, whether working or not working, may be eligible for an IRA deduction, even if their spouse is covered. Eligibility for an IRA deduction would be phased out for adjusted gross income between $150,000 to $160,000 for joint returns. Let's look at an example here. Suppose John, who is age 51 years old, is covered by a retirement plan at work and earns $60,000 per year. His wife, Julie, who is also 50 years old, earns $50,000 a year and is not covered by a retirement plan at work. Each may contribute $4,000 to an IRA in his or her own name. Each may also contribute the additional $1,000 because both are age 50 or older. The couple's AGI, or adjusted gross income, of $110,000, clearly below the $150,000 threshold, coupled with the fact that Julie is not covered by a retirement plan at work, allows her to make a fully deductible contribution. Even if she were not working, Julie would still be able to make a deductible $5,000 IRA contribution to her own IRA. The money you put aside in an IRA has typically been earmarked for retirement. That's why the government has made it very difficult to withdraw these funds before age 59 and a half without substantial penalty. While you'll always pay ordinary income tax on all earnings and deductible contributions to your traditional IRA, there are special exceptions that allow IRA account holders to avoid the pre-59 and a half penalty tax. You can use up to $10,000 of your IRA funds for the purchase of your first home. You can also use an unlimited amount of your IRA funds for qualified higher education expenses for family members or even yourself. Penalty-free withdrawals are also available if either you or your spouse are disabled, incur medical expenses which exceed 7.5% of your household's AGI, or for taking a series of substantially equal payments. In all these cases, you will still owe income taxes on the amount withdrawn, but the 10% early withdrawal penalty is waived. Now, some of you may be a bit concerned about your income needs and cash flow. This often occurs when you're faced with early retirement, or if you need to tap into your retirement accounts prior to age 59 and a half for any reason. Before making a hasty or potentially expensive decision, talk with your financial professional and your tax professional. A substantially equal payments analysis program will show you how much you can withdraw from your IRA each year without incurring the 10% premature withdrawal penalty. Since this method, which is approved by the Internal Revenue Service, allows you to take a stream of income rather than a lump sum withdrawal, the bulk of your money can continue to accumulate tax-deferred for your retirement.
Roger, that was terrific information. At this time, we'll take a short break, and Roger and I will come back and talk in detail about some of the important concepts Roger just spoke about. See you soon.
Pop quiz. Name 3 designers. Now, name 3 of your kids' teachers.
Know what really matters. Know about your kid's school. And know about your kid. Find out 100 ways to know more, do more.
What is that thing?
Looks like somebody's double chin. Must have lost it snacking on fruits and vegetables.
Somebody's gonna trip on that.
Hello. Yes. Can I ask a few questions about the apartment on Park Street?
What was your name?
My name is Juan Hernandez.
It's been rented.
Oh, it's gone. Hello, my name is Sanjay Kumar. I am calling about the apartment on Park Street.
It's not available.
Not available?
Hello, my name is Tyrone Washington. I'm calling about the apartment on Park Street.
Just been rented.
Hello, I am Chen Ling. My name is Khalid bin Ali. I'm Tuan Vo. Hello, my name is Moshe Goldberg. I use a wheelchair. It's gone. Not available. All right. Thank you.
Yes, hello, my name is Graham Wellington. I'm calling about the apartment for rent on Park Street. Is that still available?
Yes, it is.
Oh, it is?
Yes.
Really?
Housing discrimination is illegal. If you think you've been a victim because of your race, color, national origin, sex, religion, disability, or family status, call us. Fair housing. It's not an option. It's the law.
You know, this used to be a good neighborhood. Now it's a mess. You got all these polyps running around. Stick it to the devil.
Colon cancer almost always starts with the polyp. Get the polyp early and stop colon cancer before it even starts.
Where'd you think you were running to, huh?
I didn't even see you guys there. I was...
Get the test, get the polyp.
I want to talk to my lawyer!
Get the cure.
I got a phone call!
Welcome back to MoneyWise. Today we're talking about a very important topic called IRAs. I'm here with Roger Bush. Roger, why are IRAs or individual retirement accounts so important?
Well, Alan, these are very important vehicles for retirement planning. The government has not only encouraged us, but they've practically sponsored us in saving for our own retirement. And an IRA is a perfect way to do it.
Now, why is that important to have money in retirement?
Well, because in retirement, your stream of income is going to be important in order to provide you with your standard of living. You're not going to be working anymore, so you have to have a nest egg in order to draw an income from.
So in other words, I guess what you're saying is to retire with dignity.
To retire with dignity is the most important thing in retirement.
because obviously it's not just a matter of getting older. You want to continue to do the things that you've done throughout your life.
That's right. I mean, maintaining your lifestyle in retirement is what we're all trying to accomplish. But in order to do that, we need to find a savings vehicle today. An IRA gives you a tax-deferred growth opportunity.
And this is one part of a plan for financial freedom.
It's just one part. It's a great big picture, and I think that IRAs are a very important component.
Well then, Roger, what makes an IRA different than a personal account or a regular account that most of us are familiar with?
Well, the biggest difference, Alan, is that the IRAs grow tax-deferred. So when you make a contribution to your IRA, the money that you would have paid in taxes in some other account, that money stays in the account, in your name, and continues to grow tax-deferred for what could be 10, 20, 30, 40 years. That's important money that you keep in your name that can provide an income for you.
So in other words, if somebody has an income of $10,000, that particular calendar year they would be giving 28%, 15% or higher to the government as far as their tax bill due in that particular year.
If they didn't make that contribution, that big chunk of tax money would be missing. If they instead take that money and put it into their IRA account, they get to not only make that contribution, but keep the tax money and grow it tax-deferred.
Wow, big benefit. Roger, who's eligible for these accounts?
Well, as we said in the body of the presentation, Alan, anybody who has earned income or is the spouse of somebody who has earned income.
So if somebody has Social Security coming in and they've also got a pension coming in from their prior employer, or they've got dividends and interest coming in from stocks or bonds, can they do an IRA contribution?
Well, that's a good question, because that you described is not earned income. That's considered passive income.
Okay.
So by earned income, we mean that you go to your employer every day and you get a paycheck for that pay period. That's considered earned income. And if that's the case, you're eligible for an IRA contribution.
Very good. So that's a big distinction. Then how much can one contribute? Can you put in as much as you want to?
Well, in recent years, the numbers have been increasing quite steadily. This year, the contribution limit is $4,000 per person. But if you're age 50 or older, our government allows you a $1,000 additional contribution called a catch-up contribution. So the actual limit, if you're 50 or older, is $5,000.
Okay, and you should probably even bounce that idea off a tax preparer or whatever to see if it's a good idea.
It's very important to have a discussion with your tax preparer and your financial advisor to make sure that you're contributing properly and in the right amounts.
Very, very good. Roger, does it make any difference if I'm 20 years old, 25 years old, 35 years old, when I start contributing, or doesn't it really make any difference?
Well, Alan, I think it makes a big difference, because the earlier that you get started, the longer that this money can not only compound, but compound tax deferred. So it's never too late to start, but the rule is the earlier you start, the longer the time horizon, and the more this money will grow for you.
And doesn't it, in essence, get you into discipline? And I think we've talked about that at other times or with other clients about having a regimen or a discipline, just like in your physical well-being, to get into a plan.
That's right. I mean, we all have constraints and we all have demands on our money. It's very important that you pay yourself first by taking a portion of your earnings and putting it away for retirement. That, as a specific goal, is important to start as soon as possible. So, yes, it is something that needs to be addressed now as opposed to somewhere down the road.
And then really have the same percentage almost, whether your salary goes up or down or whatever, just be in that regimen that you're going to do it year in and year out.
That's right. It's habit forming and it serves as a good example.
Very good. Now, what about taking that money out? Can and when should you take it out?
Well, again, we look at these retirement accounts as a vehicle for retirement. We strongly discourage people from taking money out of the IRA prematurely. However, there are vehicles where this money can be withdrawn without penalty. You'll still have to pay ordinary income tax on the money, but in instances of purchasing your first home, medical expenses, substantially equal payments, that money, although you'll still owe income tax, can come out penalty-free.
And there are also, I think you had mentioned something about substantially equal distributions that you can take under certain circumstances?
That's right. You can take money out of your IRA prior to age 59 and a half using this method. Now, it can be complicated, so we strongly encourage anybody considering this method to talk with their financial advisor and, as equally important, talk to your tax preparer.
Good. One last point that I think is important. Somebody has huge credit card bills, debts. Should they still contribute to this long-term retirement plan?
We encourage it strongly. Now, it might take some sort of shifting around of your current lifestyle because that debt still has to be serviced. But saving for yourself, saving for your retirement is vitally important starting today. So review your expenses. Find out what you can live without so that you can service your debt and save for yourself.
That's terrific. So it's all part of a big, big plan.
It absolutely is.
Very good. Roger, that was terrific. I appreciate you walking us through that. At this time, we'll take another short break, and then Roger's going to talk about the Roth IRA, another retirement vehicle that may be of interest to our audience out there. We'll see you very, very soon.
Hey there. Hi! I haven't seen you before.
Yeah, I just moved here. I'm new. Wanna hang out or something? 'Cause I have a feeling we're gonna be best friends.
Things can get pretty ugly when you're bored. In an after-school program, you can find something way better to do.
You know, Clarence, you and I should hang out more often. You know, he wears these cheap suits, but they look good on him.
So she says, why lobster?
Polyp sighting at 16L.
You never know when a colon polyp is going to show up.
Aunt Ethel, you've been ducking me since '99 at St. Mary's. You
Get
owe
the
me a
polyp
pie.
early and stop colon cancer before it starts.
Do I look fat in this?
Don't wait for symptoms. Get the test. Get the polyp.
They love me! They want me here, don't you? Come on!
Get the cure.
These are my peeps!
Things can get pretty ugly when you're bored. In an after-school program, you can find something way better to do.
AIDS has killed more children worldwide than there are in all the grade schools in New York, Chicago, Los Angeles, Washington, Atlanta, and Miami combined. The time to do something is now.
Welcome back to MoneyWise. At this time, Roger will talk about another retirement vehicle called the Roth IRA. Roger, take it away.
Thank you again, Alan. The Roth IRA provides you with the opportunity to invest after-tax dollars to benefit from tax-deferred growth and, most importantly, to receive tax-free distributions. Unlike a traditional IRA, there are income limits for who can contribute to a Roth IRA. A single filer whose adjusted gross income is below $95,000 a year, and couples filing jointly whose AGI is below $150,000 a year may contribute the maximum $4,000 per individual to a Roth IRA, $5,000 if either or both are age 50 or older. Partial contributions are allowed for singles whose adjusted gross income is between $95,000 and $110,000, and for couples whose AGI is between $150,000 and $160,000 per year. All contributions to a Roth IRA are non-deductible. The maximum contribution to a Roth IRA is $4,000 per year, or 100% of earned income, whichever is less, with the additional $1,000 catch-up contribution for individuals age 50 years or older. Also, the $4,000 or $5,000 can be divided between a Roth IRA or a traditional IRA, but the combined contributions to these two accounts cannot exceed the $4,000 or the $5,000 annually. Provided the account owner still has earned income, contributions can still be made into the Roth IRA even after you reach age 70 and a half. The contribution portion of a Roth IRA can always be withdrawn tax-free and penalty-free. In other words, you have complete access to your $4,000, possibly $5,000, if you are age 50 or older, at any time. Obviously, if you contributed $4,000 for 10 years to your Roth IRA, that would translate into a pool of $40,000 in contributions that could be distributed to you tax-free and penalty-free in the future. This is a significant advantage over traditional IRA contributions, which are subject to penalties for early withdrawals. Withdrawals of the earnings portion of a Roth IRA are a little bit more complicated. Withdrawals of earnings depend on age, use, and how long the account has been opened. Withdrawals of earnings are tax-free and penalty-free if taken 5 years after the first contribution. However, you must be age 59 and a half or older, or use the withdrawal for a first-time home purchase, and that's up to $10,000. That's the limit. Or take the withdrawal due to death or disability. If one of these 3 reasons is present, but the account has been in effect for less than 5 years, withdrawals of earnings are going to be taxable. Withdrawals of earnings are also taxable, but penalty-free if used for higher education expenses, medical expenses exceeding 7.5% of adjusted gross income, or to purchase health insurance after you have collected 12 weeks of unemployment compensation. Any other premature withdrawal of earnings from a Roth IRA will be subject to income tax and the 10% penalty. Let's look at another example of the difference between a traditional IRA and a Roth IRA. In this example, let's assume that at age 40, you begin contributing $4,000 to either a traditional or a Roth IRA. At age 65, you then retire. During that 25-year period, your IRA earned an annual rate of, say, 8%. We'll also assume that your traditional IRA contributions were non-deductible, either because you were covered by your retirement plan at work or your adjusted gross income was above the amount that made you eligible for the deductible contribution. It's important to keep in mind here that an individual tax bracket may change while you're in retirement. In this example, we will incorporate 3 possible retirement tax brackets, where one is 15%, a second one is 28%, and a third bracket at 31%. Note here that in 2011, the marginal tax rates will revert to the Pre-Economic Growth and Tax Relief Reconciliation Act of 2001 rates. As you can see, at age 65, in all three scenarios, you will have more funds after tax in your Roth IRA. As your tax bracket rises from 15% to 31%, your Roth IRA compared to your traditional IRA account balance will continue to grow. To this point, we've covered the basics of traditional IRAs and Roth IRAs. And you may be asking yourself, can I turn my traditional IRA into a Roth IRA? The Roth IRA has that interesting feature. Owners of a traditional IRA whose adjusted gross income is $100,000 or less may convert these funds to a Roth IRA. All income from conversions is recognized in the year of the conversion, and all taxes are paid when you file that year's income tax return. Although current taxes will apply to the converted amount, no 10% premature distribution penalty will have to be paid. However, the converted funds must remain in the Roth IRA for at least 5 years to receive favorable tax treatment for certain withdrawals, such as tax-free distributions of up to $10,000 for the purchase of your first home. If you are receiving a lump sum distribution from a company retirement plan, you may not transfer these funds directly into a Roth IRA. You must first roll the funds into your traditional IRA. Then you may convert the funds to your Roth IRA. The rollover from your retirement plan to a traditional IRA is tax-free, but the conversion of these assets from the traditional IRA to the Roth IRA is a taxable event. To determine if paying taxes on your traditional IRA assets now and converting them to a Roth IRA is beneficial, again, let's look at some examples. In this example, the IRA holder is 40 years old, has $50,000 in an IRA, expects to retire at age 65, and also expects to earn 8% annually on those funds for 25 years. We will look at what happens if his retirement tax bracket rises from 15% to 28% and then again to 31%. A reminder here, again, in 2011, marginal tax rates revert back to the Pre-Economic Growth and Tax Relief Reconciliation Act of 2001 rates. Converting current IRA assets to a Roth IRA is clearly the better choice in this example, regardless of the tax bracket at retirement. We're also assuming that the taxes owed as a result of the conversion will be paid from outside sources, a different account, and that the entire traditional IRA balance will be transferred to a Roth IRA. The money that's used to pay the taxes on the converted amount could have earned interest over that same 25-year period. Those lost funds are called the opportunity cost of choosing this option. In order to be fair, we are subtracting the opportunity cost of that money that we paid in taxes from the Roth IRA balance. Based on the individual's tax bracket, at age 65, the Roth IRA balance exceeds the traditional IRA balance by a large margin. For comparison purposes, this example shows what would happen if all the funds in the traditional IRA were withdrawn and taxed at age 65. You should also remember that the funds in the Roth IRA are fully available and are not subject to income taxes. As an IRA account owner, you'll have to designate a beneficiary to inherit your IRA. Beneficiaries for IRA accounts must be named during the IRA holder's lifetime. Different beneficiaries will have different tax consequences for the beneficiary as well as your estate. Who you name as beneficiary can not only be a pivotal piece to any long-term financial strategy, but also can have serious tax ramifications if not done properly. The rules governing IRA distributions can be very, very complex. To help you plan accordingly, please consult with your financial and tax professional, and even your legal advisor.
Roger, thank you. At this time, we'll take a short break, and then Roger and I will come back and talk about the Roth IRA in detail. See you soon.
Jonesy kitty, Jonesy kitty, Jonesy cat. She is my kitty. She is my squiddy. She is my Jonesy. She is my Jonesy cat. She is my cat.
Things can get pretty ugly when you're bored. In an after-school program, you can find something way better to do.
All right, I got a little pop quiz for you. It's about me. What was my zip code? What city was it in? Name 3 kids I hung out with in the lunchroom. Name 3 kids your child hangs out with in the lunchroom.
Know what really matters. Know about your kid's school and know about your kid. Find out 100 ways to know more, do more.
There is really only one boy. One girl. One trade. One forest. One deep, dancing ocean. One mountain calling. One handful of sand through our fingers. One endless sky overhead. And one simple way to care for it all. Please visit earthshare.org and learn how the world's leading environmental groups are working together under one name, EarthShare. One environment, one simple way to care for it.
Welcome back to MoneyWise. In the last segment, Roger spoke about the Roth IRA. Now let's talk in depth about that concept. Roger, what are some of the big differences between the Roth and the traditional IRAs?
Well, Alan, even though they're both IRAs and they sound very similar, there are 2 very big differences. The first one is that a traditional IRA will grow tax deferred, and upon taking money out of the account for income, that money is taxed as ordinary income. All right? The Roth IRA, on the other hand, the money grows tax-free.
Okay, big difference.
Big difference. As long as the money meets certain guidelines, that money can come out tax-free. The first guideline is you're at least 59 and a half years old. That's an important factor. The second factor here is that the first contribution to the Roth IRA account was at least 5 years ago.
Okay.
So if you meet those 2 guidelines, the money that has been in your IRA, your Roth IRA, for at least 5 years and grown and compounded for what could be 10, 20, 30, 40 years, that money comes out totally tax-free in retirement.
Wow.
Now, that's a big difference between the Roth and the traditional, because when you take money out of the traditional, you're going to be taxed.
And you're taxed at whatever your income rate is at that time.
Whatever your income rate is at that time. Now, your income tax brackets are going to change, could potentially change in retirement. So once you retire, your tax bracket isn't set for life.
Right.
So generally speaking, comparing the 2 accounts to each other, the younger you are, perhaps the more you should look at the Roth IRA.
Very good. Roger, what about the contribution limits if somebody's trying to decide?
Right. Well, that's not a big decision maker because the contributions for both the Roth and the traditional are the same.
Okay.
And just to reiterate those, $4,000 per year, and if you're age 50 or older, you can put in an additional $1,000. That's called a catch-up contribution.
Okay.
So if you're 50...
Because obviously a lot of people, it sounds like they may not have taken care of their needs back when they were 30, 40, 50 years old. So the government has again thrown in an incentive here that is very important.
That's exactly right. The government is telling us that Social Security may not be enough, and quite frankly, we're inferring from that it might not even be there. Not only are they giving us this vehicle to save for ourselves, but now with the advent of the Roth IRA, they're giving us tax-free withdrawals by meeting a few guidelines. The Roth IRA is a great vehicle for retirement investing.
Now, Roger, you've mentioned a number of times here the word tax. Do you suggest that somebody consult a tax advisor before they decide which retirement plan might be of best interest or best benefit to them?
Absolutely. When you're talking about making this type of an investment, especially if you're going from a IRA or from a 401k account to a traditional IRA and considering whether or not to convert that to a Roth, your tax advisor is going to be vitally important to ultimately making that decision. Because remember, the move from the 401k to the traditional IRA is tax-free.
Right.
No taxes due on that. But the move from the traditional IRA to the Roth IRA, the entire amount is going to be a taxable distribution. So it's going to affect that year's income tax return dramatically.
Okay, very good. So really this is a decision that should be made in concert because this is money that you've worked for usually your whole life.
Absolutely. And Alan, quite frankly, investing like you and I do on a regular basis, it involves so much money and there's so much depending on investing the money correctly and doing it right that you should really have a very good financial advisor, a very good tax advisor, and when it comes to beneficiary designations and estate planning, you should have expert legal counsel as well.
Very good. Are there any other differences, Roger, in these accounts, or you've pretty much hit the highlights?
Well, again, these are both self-directed IRAs.
Okay.
So they're going to vary greatly as to what is the investment within the account. So to answer your question, these accounts can have great differences by individual because a 401k account, you have a limited number of investments to choose from. In a self-directed traditional IRA or a self-directed Roth IRA, the investment opportunities are unlimited practically.
So what's right for you or me might not be right for somebody else.
That's correct. And no two IRAs are going to look the same way that no two investors are going to behave the same. So again, here is where your financial advisor is a very important component. That's not to say that you can't do it yourself, but do your homework, do your research.
Well, I've likened some of this, quite frankly, to if you make a mistake in golf, you can take a mulligan. If you make a mistake in this field, you can be in really bad shape.
Yes, you can, and that's a good example. There are no mulligans with investing. So again, it goes back to the question that we discussed earlier. The younger that you are, the more time you have to make up for potential mistakes. That doesn't mean that mistakes are automatic. It doesn't mean mistakes have to occur. But if mistakes do occur or a downdraft in the market, a younger person has a longer time horizon in order to earn that money back again. Older, more conservative investors don't have that period of time in order to allow the market to repair itself.
And I guess, we in other shows and even now may sound redundant in some of the advice that we're giving and that we give on a daily basis, but it really is so important, isn't it, for somebody's well-being?
It is, because in your retirement years, as we said before, there is not a lot of extra earned income coming into the nest egg. So the money has to be invested properly. We have to control taxes, and we have to invest to offset inflation. So the older you get, the more investing with purpose that you have to have. That's not to say that the younger people can't invest with purpose, but again, there's a lot more flexibility in a younger portfolio than with the portfolio of an older generation.
Very good. Roger, you've worked for years accumulating this. Now, what about the withdrawal of funds? How is that handled here?
Well, again, withdrawals from an IRA are very contingent upon age. At 59 and a half years old, you can now begin to take a stream of income from the traditional IRA, and that money will be taxable.
Okay.
No penalty, but it will be counted as ordinary income.
Right.
Now, prior to age 59 and a half, if you take a withdrawal from an IRA account, the government is severely discouraging you from doing that.
Well, hopefully you should have this money that you don't need to take a withdrawal for a long, long time.
That's right.
Because if you live to 80, 85, 90 years old, part of this money's got to last, doesn't it?
It has to last your entire lifetime, and not only last, but keep up with taxes and inflation.
Wow. Roger, many people have started IRAs over the years at different firms or different banks or institutions. Now, can people consolidate their accounts, or should they consolidate their accounts? Is that a good strategy?
Terrific question. I advocate holding as few IRA accounts as possible, because think about it.
Well, don't you want really not to have all your eggs in one basket?
Well, if you're properly diversified and asset allocated within your IRA, that's not a concern.
Oh, really?
You can have one large IRA.
Okay.
But getting back to whether or not it makes sense to consolidate, each IRA account carries a custodial fee.
All right.
It's not assessed on the value of the account or anything else. It's assessed on the account itself.
Just because of reporting or because of maintenance or something like that.
So one account equals one custodial fee.
Okay.
Could range from $50 to $100 a year.
All right.
Now, if you have 5 IRA accounts between your brokerage, your savings and loan, your bank account, you're paying custodial fees on all of those.
Okay.
And that could potentially take a little chunk out of your performance. That money comes directly out of your IRA account.
All right, so number one is get rid of the fees if you can.
Minimize the fees.
Okay. What other advantages might there be?
Well, you also have a well planned out investment process. With 4 or 5 different accounts all over town, maybe you're working with 4 or 5 different financial advisors.
Who have different philosophies?
All with different philosophies, different investment vehicles, different expectations for what's going to happen in the future. Who's coordinating all of these people?
So you have to have kind of a quarterback for the investment accounts.
That's right. With one IRA account, whether it's traditional or Roth,
right,
you get to talk to one financial advisor, you have one plan going forward, you have one set of goals, and most importantly, one yardstick to measure performance. Now, you can do a lot of things in one account. You can accomplish in one account what 5 people in 5 different accounts were trying to accomplish.
Okay, so Mr. Smith has 5 accounts, but isn't there a big problem with fees consolidating these accounts?
No, actually, it's quite simple. You can transfer and consolidate IRAs totally tax-free. It's very easy to do. There are no tax ramifications to doing it, and it saves you money. I can't think of a better thing to do.
Roger, when we talked about rollovers, we talked about consolidating IRAs and getting those accounts in one place. One thing we didn't touch on was many people have worked for a company and have 401k account. Is that possible to do anything with that once they leave the firm, and should they do anything with that account? Because that's such a big part of American society are the 401ks.
You're absolutely right, and so many Americans have 401k accounts at one, if not more, companies that they used to work for.
So if they worked for 3 companies, they may have 3 prior 401ks.
That's right. So in the same way that people have multiple IRA accounts, we also find that people have multiple old 401ks with previous employers.
So why wouldn't they just leave them there?
Well, again, in 401k accounts, you have a limited menu of investment options.
Right.
Who would want a limited menu if they can have a virtually unlimited menu of investment options? So it's very easy to consolidate your 401k accounts from previous employers into, again, a Roth IRA or a traditional IRA.
All right.
Again, it's simplicity of ownership, a direction of investment going forward. You have your goals stated and you have your investments targeted firmly towards those
So
goals.
at their prior firm, they probably are not getting any outside investment advice at all,
Not getting
and
any.
limited choices.
That's exactly
and
right.
no tax consequence if they roll it over. And so now again, everything's in one place and more pertinent to that person's goals.
You're exactly
That's really
right.
what you're saying. All right. Well, now somebody's made the move. They've consolidated everything. Let's talk a little bit about the asset allocation and how to invest those funds, because whether they're 20 years old, 30 years old, or 80 years old, I think what you're saying is those funds might be invested differently for a different person, especially if they worked for one particular firm and maybe accumulated a bunch of single company stock. Is that a big concern?
That is a big concern, Alan, because we find that folks who have worked for one company for a long period of time, they've accumulated a lot of stock in their 401k account.
Okay.
That is, as great as the company might be, that one stock position is inherently risky.
But they've got a great emotional attachment to the company.
And that's terrific, and I wouldn't want to deter anybody from that emotional attachment. They love their company and we're behind them. However, as an investment vehicle, it's dangerous to have all of your eggs in one basket. And that's exactly the opposite of what we've been advocating here today with regard to asset allocation and diversification.
So plus, as they get older, their whole needs, where their stock may have been a growth vehicle, whatever company that is, as they get to be 60, 70 years old and move into a phase of their life where they may need income, their whole investment philosophy, whether they want to or not, being pulled kicking and screaming, they should maybe be pulled into a different investment mode.
I think it's a must, because even if that's a dividend-paying stock that they own, again, you have a concentrated position and you can diversify the proceeds from that stock out among different types of fixed income, different types of dividend-paying stocks, and the oh-so-important cash component of a retirement account, so that you can take a stream of income, a check in the mailbox on the 15th of every month.
Very good. Roger, as far as the investment performance, why does it matter? Don't all of the investments perform the same year in, year out?
Quite the contrary. Every investment vehicle is different. Although we have certain expectations of certain types of investments, we know what to expect from them. They do perform very differently, and that's why we have to have a mixture of all different types of investments. Your cash equivalent investments are low risk and relatively low return. Fixed income gives you a little bit of a higher risk and a little bit of a higher return. At the top of the pyramid, now we're talking about the highest of risks, which are stocks, and also the highest of return.
Very good. Roger, let's put this whole IRA and retirement process in the context of somebody's big financial plan. And we've also got a chart that we've used before in some of our other shows, but I think it really should be studied in depth every single year as far as what somebody should be looking at. Let's take a look at this chart and kind of go through it. And it's a chart that I think you've used with clients before.
Sure.
So basically, when we talk about the basic questions that you ask of somebody, and we go right down the first item, which would be, have your goals changed? And of course, the first item we look at is retirement, because if somebody basically has retired, not retired, what kind of questions do you ask?
Well, in retirement, or as you approach retirement, I like to ask clients, what do you have in your mind's eye as your perfect retirement? Would you like to travel? Some people don't travel. Would you like to play golf 5 days a week? Some people don't play golf at all. So really, it's kind of a fun exercise, isn't it? In your younger years, trying to envision the type of retirement that you'd like to live out. There are no restrictions to this. This is the imagination gone wild. Just the key is to try and define the lifestyle that you'd like to lead, set your goals, and put together a plan to try and get you from where you are now to where you want to be in the future.
I guess it's really, if you use the analogy of flying an airplane, it's no problem to make a mid-course minor adjustment, but it's a big problem if you're going up and down and navigating around mountains.
That's exactly right. And the funny thing about all this planning, Alan, is that it changes constantly. What you decide and what you envision today will probably be totally different a month from now, a year from now, certainly 10 years from now. So, just like the old adage in real estate, location, 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 I think when it comes to financial planning, the adage is review, review, review.
Very good. Roger, let's talk about some of these other issues, not particularly related to retirement, but again, I think it's one big package. Will you just touch on some things like insurance and some of the other issues that you bring to the table when you talk with people?
Well, it's very important that when you're working with your financial advisor, that person knows all aspects of your financial life. It should not be the least bit uncomfortable for somebody who wants to control and maintain a good financial plan. The same way that you go to your doctor and you fill out a form listing every disease you've ever had and any ailments that you currently have. It's the same with your financial advisor. In order to make valid and accurate recommendations, that advisor needs to know brokerage accounts, life insurance policies, bank account balances. It's not because the person is being nosy. It's because they're trying to get a firm grasp on who you are financially. And based on that information, they can make recommendations for the future.
Thanks, Roger, for participating in today's show. I'm sure our audience got a lot out of it.
Thank you, Alan.
In today's segment, we talked about the advantages and basic facts of IRAs, asset allocation within those accounts, and how these accounts can be an important tool in achieving security in retirement. Our mission is to help you make better financial decisions for you and your family. If you'd like more information on this topic, please call the numbers shown at the end of the program. We thank you for watching and hope to see you again on another segment of MoneyWise.